And welcome back, everyone. My LLs, my Lubari listeners, my fellow real estate investors, and my fellow real estate enthusiasts. Welcome back to another episode of the Lubari Real Estate Podcast, where we break down everything you need to know about multifamily investing. And I am your host, Jasam Lubari Olds. And today we're gonna talk about something that gets every investor excited. Paying $0 in taxes. Yeah, you heard that right. $0 in taxes. Multifamily real estate comes with some of the most powerful tax benefits available. And if you know how to use them strategically, you can legally minimize, sometimes even eliminate your tax burden while growing your wealth. So whether you're an active investor, a limited partner, or just getting started, stay tuned because we're going to unpack the tax saving strategies that make real estate one of the best wealth building tools out there. So let's dive in. Okay, first, let's talk about why real estate is such a powerful vehicle for saving on your taxes. Unlike earned income from a W-2 job, which is taxed at some of the highest rates, real estate income benefits from several deductions, depreciation, and deferrals that help keep investors more of their hard-earned money. The U.S. tax code is designed to incentivize investment in housing and infrastructure. So that means as a multifamily investor, you're rewarded with tax breaks for simply owning and operating rental properties. One of the biggest tax advantages in real estate is depreciation. The IRS allows you to deduct a portion of your property's value each year as an expense, even though your property may actually be increasing in value. This is called paper loss, and it can significantly reduce your taxable income. For residential real estate, the IRS allows you to depreciate a property over 27 and a half years or so. So if you own a multifamily property worth, let's say, $1 million, excluding the land value, you could potentially deduct around $36,000 per year in depreciation alone. That means if your rental income is about $50,000, depreciation could bring your taxable income down to just $14,000 or even lower with additional deductions. Okay, now let's take depreciation to the next level. And this is with cost segregation. Instead of spreading depreciation over 27 and a half years, a cost segregation study allows you to break your property down into different asset categories like appliances, fixtures, flooring, and even landscaping. That can be depreciated much faster, often in 5, 7, or 15 years. Even better, with bonus depreciation, you can take a large chunk of that depreciation up front in the first year of ownership. So imagine buying a multifamily property and being able to write off hundreds of thousands of dollars in the first year. That's how investors dramatically reduce or even eliminate their tax liability. Okay, so here's another thing. Have you ever heard of something called a 1031 exchange? This is another incredible strategy that allows investors to defer paying capital gains taxes when selling a property, as long as they reinvest the proceeds into another like kind property of equal or greater value. So instead of paying the IRS, you're able to roll profits into new, potentially larger investments while continuing to grow your portfolio tax free. Best part about it is there's no limit to how many times you can use a 1031 exchange, meaning you can keep deferring taxes indefinitely while compounding your real estate wealth. And here's something a lot of people don't realize. If you qualify as a real estate professional, or if you or your spouse have passive income, the losses from depreciation and operating expenses can be used to offset other sources of taxable income. For example, if you're a high income earner with passive real estate investments, your losses can significantly reduce your tax bill, even outside of real estate. This is why so many doctors, lawyers, and business owners invest in multifamily properties to shelter their income legally. And if you want to maximize your tax savings, you might consider qualifying as a real estate professional in the eyes of the IRS. This status allows you to take unlimited passive losses against active income, which means your real estate tax deductions could offset things like W-2 income or business profits. So to qualify, you need to spend at least 750 hours per year actively managing or participating in real estate activities, and it must be your primary business. So many full-time investors use this to keep their tax bills close to zero while building massive portfolios. Now, if you are a limited partner in a deal, you still benefit from many of the tax advantages. As a passive investor, you receive your share of depreciation and other write-offs, which means the income you earn from distributions is often tax deferred or even tax free in the short term. This is why so many investors love syndications. You get the cash flow and the appreciation without the headaches of managing properties, and the tax benefits flow right to you. All right, let's recap. Today we covered how multifamily real estate investors can legally reduce or even eliminate their tax burden by leveraging depreciation, cost segregation studies and bonus depreciation, 1031 exchanges, passive losses and tax offsets, real estate professional status, and tax advantages for limited partners. The key takeaway: the tax code rewards real estate investors who understand and apply these strategies. This is why the wealthiest people in the world invest in real estate. In my opinion, it is the most, but it's one of the most tax efficient wealth building vehicles available. So, if you want to learn more or need guidance on how to maximize your tax savings, be sure to consult with a real estate savvy CPA. And if you're interested in getting involved in multifamily investing, reach out to me at Jason, that's Jaisun, at Loubarri.com, Loubarri.com. That is my email. You can reach out to me anytime, or reach out to me on Instagram at Loubarri_real estate. And now we move on to my favorite part of the podcast where we talk about what real estate can do for you. So this past weekend, it was just amazing. The weather warmed up and everybody was just outside. And so like here in DC, we had the Cherry Blossom Festival, and it was just so great to see so many people come out to see these trees with these beautiful flowers and just everyone having a good time, enjoying themselves around the Capitol area. You had people all around the Washington Monument, all in the park, enjoying, taking pictures underneath the trees, sitting on the trees, just having a grand old time, flying kites and, having barbecue. Speaking of barbecues, yeah, invite me to the cookout. I love me a to-go plate. And if you're making mac and cheese, I'm going to be there. I will definitely be there if you invite me. I'm not just going to show up at your door now. That's not very nice. But I'll be there if you invite me. I'll eat that mac and cheese and I'll tell you how you did. Honestly. Don't invite me if you don't make no good mac and cheese, though. I won't show up. Nah, just kidding. I'll be there to support. I love y'all. Well, that's it for today's episode of the Lubari Real Estate Podcast. If you found this episode valuable, make sure to subscribe, hit that like button for me, and leave a review and share this with someone who needs to hear it. Thanks again for tuning in, and I'll catch you guys on the next episode next Tuesday. I love you all, and be blessed.